of balance sheet, I mean basic concepts in balance sheet, income statement,
Okay.
cash flow. Yeah, so we just ran through some, some what are the components of the balance sheet and all. Yeah, what does it each state? What does it each of these financial statements mean? Yeah, how is it actually generated also? And then
Hmm.
we agreed that okay, you guys go through these notes and this formulas I mentioned yesterday also. This is very critical for us to, understand anything related to anything, any measure related to profitability. You need to understand this. So,
Which formula?
so can you see my screen? So this key definitions in
Yes.
profitability. Yeah. So this is very important actually. So this is how you, if you want to analyze an income statement, this part is very critical so that you're very clear on the concepts of how do you measure? Because in the end, it's all about cash flow and profitability. Yeah. So
Yeah.
if you need to understand about profitability, you need to understand all these concepts. I mean, it's not a lot of formulas actually. You need to see how this pyramid gets shorter and shorter, and from sales, how do we reach to net profit? That is what we covered.
Done.
So, and then today we agreed that, okay, if you guys have gone through that, any specific questions on this, you can ask me. Like, if you have any doubts on balance sheet or income statement or on cash flow, I can clarify that upfront. And then we move on to as much ratios as possible today.
Done.
One question I would ask Vilas again, though you have already clarified that to me, but I, for the uh, benefit of larger group, I would just, okay, when we go through the ratios only, you will tell now how the balance sheet and income statement thing is.
Yeah, you will understand
Huh,
when
huh,
you're
okay.
talking about the earnings part. You will
Huh,
get it.
you will go through there, right? Huh, okay, no
If
problem.
it is anywhere, if you want to stop me, feel free to stop me. Yeah, because our objective is to finish as much ratios as possible. Let's try to spend 1 hour, and I think 1 hour should be sufficient to cover most of the ratios. Yeah, and then if you have any further doubts, we can connect probably on Wednesday. Hopefully by then I should be done with the valuation notes also. So I can tell you more because as I mentioned yesterday, I'm not an expert in valuation or in risk management. But more than happy to talk to you through on valuation base. Yeah.
Just a thing, Vilas, they covered only the DCF valuation, no?
Sorry, which one?
They professor covered only discounted cash flow.
No, no, intrinsic, I think.
Intrinsic. Okay, I don't even know. I mean, he covered only one method actually. Yeah,
Yeah,
I don't recall the name. Yeah,
because
but
intrinsic, yeah, I think.
yeah, but for the
Only
purpose
intrinsic.
of exam, yeah, intrinsic. For the purpose of exam, I think that should suffice. Yeah.
See, the
Okay.
purpose of exam, you just need to go through that. He said he'll ask a problem, right, on how the other thing is calculated. Uh, what was the last session?
He was
Risk
covering the
management.
VAR model.
Sorry,
He
yeah,
was covering the VAR model, isn't
VAR
it?
model, correct. Yeah, correct.
No
Sorry, yeah,
value at
Okay.
no value at risk was covered by risk management
yeah,
professor,
risk
right?
management. Yeah, yeah, correct. Sorry, not valuation. Yeah,
Yeah. So that
Oh, so
that
there
that,
were
that
two classes.
yeah. So the first one regarding valuation was covered by that Rajat Bose,
Rajat
Professor
Bose.
Rajat Bose, and the value at risk, which is part of the risk management, was covered by another professor. I forgot his name.
Done. Okay.
Paul.
Then we don't have time.
Yeah,
Sorry.
Samit Paul. Samit Paul. Yeah, yeah, yeah.
Okay. So let's go ahead.
Okay. So basically, any questions on Saurabh? I know that you didn't attend yesterday's class, but do you have any questions? Did you had any chance to go through this file or any of this professor's notes or slides? Do you have any questions
Right,
on these three components?
right now, no. I'm just listening, and I'll go through these notes, and will ask you surely.
No problem. So just
Perfect. I'll just wow. ठीक है. Sure, sure. Please share the link. मैं कल सुबह देखता हूँ फिर. Perfect.
okay. So in the interest of everyone, I will just summarize these three components again. Okay. So we have when we say financial statements, when you say financial statements, where do you see this actually? You see this in annual report, right? Typically, you see this in annual report or in monthly management information system reports. So the annual report has got so many components. But when we say financial statements, it has only got three components. One is balance sheet, which states how much assets and how much liabilities does the business have. That's the purpose of balance sheet. So it's all about what is the assets that I have. Like for example, if you have a motor car, that is your asset. Whereas if you had borrowed some money from the bank to finance the motor car, that is a liability. This is that's the concept of balance sheet. And in the balance sheet, you will also find what is the capital that has been contributed by the promoter, and how much external liabilities do they have, how they have actually deployed the funds into assets. That is the purpose of the balance sheet. When we reach into income statement, this is different. So this statement explains how profitable was the business during that period. So comparing it against the balance sheet, I always give this example of, if you buy a motor car, that is an asset. That is not part of your income statement. What is part of income statement is, like for example, if you're running it as a taxi, whatever revenue you're earning from running the taxi is your revenue. And whatever expenses that you pay for the salary of the driver and the fuel that you use for the car, that is an expense, and that these two expenses and income form part of the income statement. In the end, you can determine the difference between your revenue and expenses as the profit. As simple as that. Yeah. Whereas the asset that you were using for so anything that you are using for seeding the business, or any kind of funding that you need for seeding the business, and the kind of assets that you build or the net worth that you actually build is the balance sheet, whereas the day-to-day revenues and day-to-day expenditure forms part of the income statement. And the third element is the cash flow, which is the most important one, which states how much money have you got, and how much money have you got at the beginning of the period, which could be year or month, and how did you spend that money, and what is your ending bank balance. Because by the end of the day, the investors or promoters, whoever it is, they might be looking at your cash situation, not just the profitability. What is the use if the business is profitable but it doesn't have enough funds in the bank account? That is why if a business has got, that's why I always said, if the business has got continued negative cash flows, that means that the company is in trouble. Why there could be a difference between cash flow and profit is, you might be selling certain goods on credit. Yeah, and you would have sold it at a very high margin, but it doesn't mean that you will have the cash unless he has paid the money on a timely basis to you. And of course, for the business, it's not just one customer, right? So there will be a lot of customers. They will be granting a lot of credit. They might be getting a lot of credit from their suppliers as well. It's how judiciously they manage the payments to suppliers and the payments from customers actually determines the efficiency of that cash flow. And of course, the inventory turnover cycle and all those things we'll cover later. But this is the basic objective of understanding what is a cash flow. And cash flow, I mean, always we say that cash is king, right? Customer is king, right? But in finance, we say that cash is king, yeah? Because you need money, everything, you need money in your bank account, right? So that is the purpose of the third statement, which is the cash flow. So now we are going to study so the income statement definitions. I will not get into this again, but we will straight away go into the ratios, okay? Now, there are certain ratios that will be expressed as absolute measure. Absolute measure is nothing but a value based, wherein we are not considering any percentages or anything. And there are ratios that are actually, times or percentage or, days. It depends, yeah. But the first one we start with is the absolute measure. So if you recall, so let's take the total assets first. But before we take the total assets, recall. Let me just put it in a different sheet. Yeah. You remember this diagram from Professor? This is actually a beautiful way to look at the balance sheet. Yeah. Am I audible?
Yeah, you are. Yeah, I can hear you.
So there are the easiest way to look at the balance sheet is, okay, you have two sides. asset side and the liability side. Liability side, as I mentioned, this is the source of funding, yeah, and the asset side is the how do you deploy your funds to build the assets. So on the asset side, you will have fixed assets plus current assets. Fixed assets are any assets that you intend to use for more than 12 months. Like for example, motor car, plant and machinery, your land and buildings, all these are fixed assets. Current assets is anything that you intend to realize within the next 12 months. Like for example, you have stock of goods that you intend to resell. That is your inventory. That is a current assets because you are intending to sell it within a period of 12 months. You have you have sold goods on credit and you are supposed to receive that money from your customer. That is, you are going to receive that money definitely within the next 12 months. That is your current assets. Yeah. So these are the examples of fixed assets and current assets. And on the other side, so you have owner's fund. OF is owner's fund. Sometimes we call it as equity or shareholders equity. This is a combination of your share capital that the promoter has actually contributed to the business plus any retained earnings. When I say retained earnings, these are nothing but profits that have accumulated into the business over a period of several years. Yeah, because today I made a profit of 100. I distributed 50 as dividend. So 50 is still retained in the business, right? So that is called the retained earnings. So it's always the capital plus money that has been reinvested into the business by way of not eating up the profits by themselves. That's how I call it as retained earnings. Is the concept of retained earnings clear for everyone? Yeah. Please.
Vilas, what is OFLTL here?
Yes.
Okay, we haven't reached there. So is owner's fund clear for you? So owner's fund is share capital plus your retained earnings. Is the concept of retained earnings clear for you? Anamika.
Absolutely.
Clear. Okay, good.
The amount that we plow back from the profits, from net profit, the amount that we plow back to the business is retained earnings.
Yeah, because tomorrow, assume that tomorrow at any point in time, if you want to repay this money, you need to repay this amount as well to the owner, right? Or to the shareholders, or if the company goes for a liquidation, or if they want to repay back.
Repay as it, acha. Okay.
You need to, because imagine today that you are going to assume that you are going to wind up the business today. This year, this money, this business owes to the promoter, right? Because this money belongs to the promoter, right? Even
Yes.
in the end, he can take it, right? So what he will take it is whatever money he has contributed till date, plus the profits that he has made from the business. That is what he will take, right? That is his worth. That is his net worth, right? So that is why we always consider share capital plus retained earnings or accumulated profits. That is the OF share, owner's fund or shareholders equity or equity. Then we have something called long-term liability of $250. This long-term liability is nothing but any loans or borrowings you are taking it from an external financier on a long-term basis, i.e., which is more than 12 months. Like for example, as I mentioned, you purchased a motor car on loan, right? So that loan will appear here because it's more than 1 year. That is the long-term liabilities. Then you have current liabilities, which is like a day-to-day credit facility that you're getting from the bank as an overdraft facility or your cash credit facility. The credit that you're getting from your supplier that he will wait for 2 months for you to pay him the money. All these are your current liabilities, meaning that you should pay them within the period of next 1 year. That is your current liability. So again, on the liability side, you can see whatever amount that the business owes to various parties, and on the left side assets you will find how much money has the business got as part of its assets. This is clear, right? This all these blocks are clear for you all, right?
Yeah.
And it should
Yes.
always yeah. So there is a basic accounting equation, meaning that this I was mentioning to you some time back, there is something called the double entry system of bookkeeping, which or the accrual basis of accounting. Because historically, when we were when we were maintaining books of accounts, we use something called single entry system or cash basis of accounting. This was very old days. Some government organizations are still following it some part of the world, but still it was a very old practice. Like you might find it in some small shopkeepers doing this. They record transactions in their books only when they receive money or payment. If not, they will not record it in the books. That was the old system. This system got replaced by accrual system or double entry system of bookkeeping, which will record transactions if the transaction has occurred, regardless of whether cash has been received or not. Like for example, in the single entry system, you will book the transaction if cash has been received, meaning you have sold goods on credit. You will not record that as a sale in your system. You will only record somewhere in your ledger or your diary book saying that this customer owes me this money. But that is not how the proper accounting of the double entry system works. Now, even if you're selling goods on credit, you will record this in the system as money to be received from some customer. So there is always a debit and credit. So that is why, you know, every transaction there will be a debit and a credit, and the total of debits and the total of credits should always tally for a transaction at a transaction level and at an overall level. That is why you will always find that the total of assets has to be equal to the total of liabilities. Otherwise, if this amount doesn't match, there is something wrong. Yeah, because at a transaction level, every transaction, if it's like for example, if it's 100, there should be 100 debit and 100 credit. It will flow like that. So you will have a lot of transactions. Everything will have a debit and credit of equal value, and then in the end, both debits and credits should have the same value. So that's why the total of balance sheet should always be equal. The total of assets should always be the total of liability side.
That's why net profit always sits on liability side, right? Balance. That's why net profit always sits on the liability side to balance the balance sheet or whatever.
Exactly. Correct. Correct. Whatever difference is there in the income statement, it flows to the balance sheet to make this tally. I mean, there are a lot of accounting entries that happen in the background, but I don't want to get into those. Yeah, it will complicate things for you, which I don't want, which is not needed also for you. Yeah, but always understand, because the basis of this equation is what this ratio is saying. Yeah, because company's total assets. So we are into the first ratio, which is the total assets, which states that the company's total assets are equal. Total assets is 1000, right? So I have marked it in green. So total assets are equal, always equal to the sum of its liabilities and shareholders' equity, which is shareholders' equity is owner's fund plus liabilities is long-term liability plus current liability. So this is 1000. So that's why we can compute the total assets either fixed assets plus current assets or owner's fund plus long-term liability plus current liability. So what is the total assets of this company is 1000, right? As simple as that. You add up fixed assets and current assets, you will get 1000. Basically, the purpose of this ratio is it actually captures what is the relationship between the fixed assets, liabilities, and equity. Yeah. If everything remains constant, as in if everything else in this balance sheet remains constant, the equity will increase when you increase an asset. Like for example, if you are buying an asset, it will increase the fixed assets, right? Correct. If you're buying an asset, it will increase your fixed assets. But there has to be a corresponding other side also, right? So if there is no change in the long-term liability or current liability, it means that the owner has funded that, right? That is why it says that all else constant, the equity will actually increase when asset increases. Yeah. Increase in liabilities decrease equity. Yeah. Increase in liabilities will decrease equity. Meaning that if you purchase this asset, if it was a loan, then this would have already increased the long-term liability, right? So that will actually decrease the equity. That is what it says. I mean, it's a very simple ratio. For me, it doesn't convey quite a lot of meaning. I mean, it's just to show how much is the value of the total value of the assets for a company. Yeah, but it's not even net worth or anything. So it's just a simple measure. But why I showed you this one was to understand the relationship between all these things. Is this clear? This ratio clear?
We'll ask one question here.
Yeah.
It may be a very basic question, but normally, if I consider my machinery as an asset,
Yeah.
for example, in my industry, automotive industry, it's all factory and machinery. So there will be a depreciation in the asset cost also. Am I right?
Correct.
So how do we balance out, in that case, assets and liabilities?
Yeah. So depreciation is, why we, provide depreciation is for two reasons. One is that, your assets will be worn out during the useful life, right? Like, for example, if the machinery was purchased today, after 10 years, that machine will be worn out, right? Or it will be kind of in a position that you need to scrap it, right? So
Correct.
there is a depletion in the value of the asset. That is one thing. Second thing, after 10 years, you need to replace that asset, right? You need to buy a new machinery, right? So
Correct.
where do you get the funding from? You need to find the funding from your 10 years profit, right?
Okay.
A portion of the profit you need to set aside. That setting aside is called depreciation. So depreciation will be an expense in your income statement. So you see here depreciation. So you have your cash profit. From cash profit, you set aside a portion called depreciation. This will meaning when you say set aside, in the end, it means that you are not giving that profit to the owner as dividend. They cannot take this money back first. They need to reinvest this money into the business if they want to replace this after 10 years.
Okay. Okay.
So what happens here in terms of the balance sheet, how that will appear is, when you say the fixed assets value here, it's actually the cost of the asset, original cost of the asset minus whatever depreciation has been charged till date, and so this is the written down value. So what is the value of the
Okay.
yeah? So whatever depreciation, so assume that the asset was purchased 2 years back, my asset cost 600 will be maybe 1000 minus 400 that I have already charged through these two years as depreciation. So that 1000 minus 400 is the 600 that what you're seeing here. So this is the actual value as of today, because 1000 worth of machinery, if you sell it today also, you will not get it. Right? You might maybe second hand now. You might get it only. You might be able to sell it only for 600. So that way also, you need to check your assets. What is the net realizable value? Now, if fixed assets we call it a written down value, yeah, which is your cost of assets minus depreciation. That gives you the written down value.
Okay.
Clear?
Okay. Yeah.
Okay.
Yeah.
The next one is capital employed. Yeah. So capital employed is how much capital you are using in the business. Yeah. Which could be calculated in two ways. One is, either you add fixed assets plus current assets minus current liabilities. So this portion. Yeah. Whatever assets net of your current liabilities that you have is how much capital you have employed in your business. When you say capital, it's not just the owner's capital, but even the long-term capital that you have borrowed from external parties. Yeah. So this gives a snapshot of how the company is actually investing its funds. Yeah. But again, this doesn't mean anything for most of the people, because you should always consider clubbing it with the return on capital employed. What is the return on capital employed? That is what the shareholders will be more concerned rather than just looking at the capital employed. Any questions on capital employed or? shall we move to the next one? It is very important actually.
No, it's fine. It's fine.
Yeah. So net worth is the most important one. Yeah. So this tells you how wealthy you are, your company is. Yeah. So basically, it tells you what is the net book value of the company. When you say net book value, it means that whatever assets I am earning, whatever assets that I have, net of my external liabilities. Same thing applies for us also. Like if we are measuring our own net worth, we will take all the assets that we have in our, in our lineage, and then you deduct whatever is the bank loan, then the remaining is your net worth, right? This is what the politicians also declare. Yeah, they might be undermining the net worth, but they will be declaring these much assets I have, this many liabilities I have. So the difference is the net worth. Same thing applies for the company also. So this actually helps to measure only the book value, but it doesn't measure what is the market value, but it's just the book value. So you can calculate it in two ways. So it's nothing but share capital plus your accumulated profits, or you can calculate it this way: fixed assets plus total assets minus your total liabilities, and then this will give you what is the net worth. Yeah. So how do you interpret this? Is if your company is consistently profitable, yeah, your net worth will always rise. As simple as that, yeah. Because today you have invested 100 in the company. Tomorrow, after 1 year, you have made a profit of 20. So automatically, your whatever you are supposed to get back from the company, or whatever is your investment in the company, has increased from 100 to 120, right? That is your net worth. Provided this 20, I never claimed it back as dividend. If I claimed it back as dividend, which means that the company has distributed its profits, then if the company has distributed 20, entire 20, my net worth still remains the same because I've already taken that 20 back. Whatever is remaining is still the original capital. Whereas the company has not paid that 20, that will be that belongs to me in the future. So that is why it adds to the net worth or the owner fund. Now, this net worth ideally should be positive. It has to be positive, yeah. Because if it's negative, what does it mean? If you go by this formula, if it is negative, it means that mathematically your liabilities are more than your assets, right? Assume, for example, fixed assets was 600, current assets was 400, long-term liability was 3000, yeah. So this means that your minus is more, which is net worth is negative. This means that your total liabilities are actually exceeding your assets, and the creditors will not be confident on whatever, to lend money to your business, because they will think that if your liability is more than whatever assets you have, it means that in the event if I need to liquidate your assets does not fetch a value that is equal to what they owe me. That is what the purpose of this ratio of net worth. This is a very important ratio actually. Is it clear?
Yes. But how startups are inflating their net worth? I don't understand this.
Huh?
I'm saying how
Sorry?
startups usually. Hello, am I
Yeah.
audible? I'm
Yeah.
saying
You're
how
right.
startups are inflating their net worth.
See, there are so many ways of inflating your net worth. I mean, I don't want to get into that. See, there are a lot of ways. Like you might be, there are sometimes, you might say that you might be jacking up your sales, yeah, and profits, yeah. So that will get added to the owner fund. That is one way. Then you might be over under declaring certain liabilities, yeah, or overstating certain assets. These are all possible, yeah. I think
Okay.
the most classic one, Satyam one, right? I mean, it's not a startup or this thing, but they jacked up the value of the current assets. Sorry, the fixed assets, not fixed assets, long term assets. And there is something called, okay, it's part of your bank fixed deposits. They declared some money lying in bank account as fixed deposit, which was never there. So there are ways. There are ways of accounting manipulations that happen in the back end, which actually tells you, which actually can lead to financial statement misstatements. Yeah.
Okay. Okay.
Okay. So that is the
Please,
purpose
please
of
go ahead.
just
Perfect.
one. Yeah. So then the next one is, so far we have covered some things at the overall level. Yeah. So we looked at the total liabilities, total assets. What is the if you add total assets minus current liabilities, you get your capital employed. Then you get total assets minus your total liabilities, you get net worth. Now we get into operational ratios wherein you are analyzing certain components very specifically. Like for example, the first one is the current ratio. Current ratio, very simple. It's your current assets divided by your current liabilities. Yeah, it just means how much, what is your company's strength of its current assets to meet its current liabilities or short-term obligations. Yeah, meaning if my current assets was 400 and my current liabilities was 200, say for example, it means that I have twice current assets. Yeah, I have 2 times current assets to settle my current liabilities. Yeah, and basically, if you have a current ratio more than 1, in this example, you can see 400 and 300, which is more than 1, right? So current assets divided by current liabilities is more than 1, right? So maybe 1.25 or whatever it may be. It means that company has got enough short-term assets to liquidate its short-term borrowings or short-term liabilities. Yeah. And current assets is a combination of inventory, receivables, and any other quick assets. That's why some companies always consider not just the current ratio, but they consider something like quick ratio. Why quick ratio? Is because your current assets includes your cash and bank balances plus inventory plus your customer receivables. Now, customer receivables in many cases might be very difficult to liquidate in the next 90 days. They might take more time, or they might take some companies that are investing heavily on inventory. If there is inventory obsolescence or if the inventories are slow moving, it means that theoretically you cannot liquidate those or convert those inventory into sales in the next 90 days. So if you're just looking at the current ratio, it's not the right mission. So that's why we use something called quick ratio, which is a combination of quick assets and current liabilities. So quick assets is your cash and cash bank balances plus any marketable securities plus accounts receivable. Yeah. So this will, if it's more than 1, it's well and good. But usually, most of the companies try to keep the ratios between 0.1 and 0.25 because if it's more than that, it means that they are holding too much cash. Yeah. So this quick
There will be a
ratio is,
difference between current and quick, you are saying, Vilas?
yeah. So here,
You are then saying that there is a difference between quick and current?
so quick current ratio is the major bucket. Quick ratio is something within that bucket because in current ratio you are using current assets, and in the quick ratio you are using quick assets. So current assets is a combination of cash and cash equivalents, inventory, accounts receivable, marketable securities, and other prepaid any amount that you have paid in advance. Out of this, what can be easily converted into cash? You just think about that. Cash. Cash anyway. Inventory. If it's an inventory company with inventory, especially slow moving inventory. You cannot liquidate that inventory in the next 90 days, right? It will take a long time to liquidate, right? Or to convert that into sales. So you exclude these kind of items from your current asset and you get something called quick assets. This is your real, ultimate test of liquidity. If you were to, consider that you need to wind up everything in the next 3 months, how much of my current assets, how much of my assets, quick assets that I have to pay off my current liabilities? That is what the quick ratios is. Again, quick ratios, even if you see here, quick ratio, you need to be very careful whatever elements that you're including here, because accounts receivable, even though you are including it here and you are excluding only inventory from here to here, if the accounts receivable period is too much, yeah, then this you need to exclude that from the quick assets. But for the purpose of formula and for the exam, you can understand, you can always include that, yeah, and you will exclude only those items that are not really quick. The inventory is one classic example, yeah. Is it clear, quick versus current?
Yes, yes.
Then the next one is your interest coverage ratio. So this is, this we use to determine how much money has the company got as profits and compared to how much interest it has to pay to the for its capital or for its interest. Yeah. So we sometimes we call it as times interest earned or debt service coverage ratio. Yeah. And it always says how many times I can pay. Like for example, if my earnings before interest and taxation was 100, yeah, and my interest expense was 20, I can say that with my current profit, I can pay up to 5 times of my interest, which is good, right? Now imagine if my profit was 60. It means that interest expense was 20. 60 by 20 is 3 times only, right? So decreasing is not good, right? Meaning that your profits are not sufficient to cover for your interest. Like for example, if this became 20 also, same, the profit also became 20, interest is also 20, so you literally don't have anything left after you pay your interest. So interest coverage ratio is 1, yeah, which is not good. So that's why at least 1.5 has to be there as a minimum acceptable ratio. Otherwise, the lenders will say that, boss, you don't have sufficient profit for you to pay me, because 0.5 and all is always wobbling, and it's a safety margin. If anything below that 1.5, they will say that no, boss, you don't have sufficient money to pay for your interest. Then how can I finance it based on your historical performance? Now, this coverage means it's either for the quarter or for the financial year. Now, if you are thinking about a quarter, you need to take these both as quarterly expenses and quarterly earnings. If you are considering for one full year, both the numerator and denominator has to be for the annual value. Clear?
Yes, for me it is.
Saurabh?
Yeah. I don't know.
So who else do we have? Abhijit, Rajiv, is it clear?
Yes, yes.
The format is clear. Yeah.
Pawan, please feel free to add something if I'm making any mistakes. Okay. Okay, fine. So that is your something related to how your creditors would be very much interested in, like how much money you are generating to repay their interest, not the principal but the interest. Yeah. Then another important one is debt equity ratio. Yeah, this is the something called gearing ratio. Yeah, which measures how much is company's financial leverage, or how much of external financing has the company got. Yeah. So it's usually divided by what is your proportion of total liabilities to the shareholders' equity. So you see here, what is the owner's fund divided by the long-term liabilities. Yeah, I think it's only long-term liabilities. Yeah, total liabilities. Sorry. So how much of it is, debt, and how much of it is equity? Yeah. So the catch here is, what you need to understand is, if the cost of debt financing is lower than your cost of capital, it means that you should ideally go for more debt financing. Yeah, because imagine cost of your debt, cost of getting a loan from a bank is, say, for example, 6%. Yeah. Whereas cost of capital, as in, if you are investing your money in some other business, if you are getting 10% return for that, which one is cheaper? You tell me.
Bank loan.
Bank loan. So you should go for bank loan then, right? Go for bank loan. Don't contribute further capital, because you are losing. You could have invested that money somewhere else, and then you could have earned more money, and then whatever that 4% increment is your ultimate net profit in your books, or in your in your ultimate parent company, right? Whereas if your cost of capital was 3% and the bank is charging you 5%, definitely you will go for pumping more capital on your own. That is one thing that we need to understand. So that is why, if that be the case, yeah, if your cost of debt financing, it's more than your additional income that it generates, then that's why the share price might drop. Yeah. So usually a ratio of less than 1 is considered as relatively safe, meaning that your debt to equity is more and debt is less. That's why it says less than 1. Whereas value is about 2, meaning that my debt is twice as my equity, that's considered very risky. Yeah.
Yeah.
Now,
But in a situation where my debt is of lesser cost, in those situations, then that is not a bad situation to have, right? As you
if you
said.
yeah, if your debt cost is lower, then it means that more lower than the cost of your capital. Yeah.
Mm,
Then
mm.
then it
Then
means
it is
it's a,
not a bad situation to have 2:1, right?
again. So
No, I'm saying
yeah, I see your
if
point.
the cost of debt is lesser than the cost of equity, then it is always it is not a bad situation to have if I have a 2:1 ratio. Might be at a later time when when the cost of debt increases, I might have to change the dynamics. But then at a point where where the cost of debt is less, at that time it is not a bad thing to have.
99246 and 95964
Yeah, I get you, but there are certain other things, like for example, when you go for external financing and all, they might think that, okay, this company is already, if you want to attract an investor, they might think that, oh my God, this company is external debts are more than its equity, or twice its equity. Maybe the company was very careful enough to making sure that the cost of capital was lower than the cost of, or sorry, the cost of debts was more than, less than the cost of capital. But as an investor, there has to be a balance, right? You cannot go for long term, because in your business, if you say you're as part of your net worth also, if you say I have 10 rupees in my bank account, but I have 90 as my bank loan, is that a good situation? It's not a good situation, right?
Vilas, tell me one thing. When you calculate total liability,
Yeah.
the retained profits are also included in that.
No. Share, it's included as shareholders' equity.
But
So
it will also come in the liabilities also, no?
it is the total liabilities, but the long-term liability plus the external liabilities. So basically, long-term plus current liabilities, or just the long-term liability in some cases. The
And the
shareholder
retained earnings will not be included in that.
retained earnings will be included in the owner's shareholders' equity. Shareholders' equity, as I mentioned, is combination of share capital plus retained earnings. So how much money has the shareholders got versus how much money has the external borrowers got, or the right on the company. It's not the right, I would say. How much money is owed to external parties versus how much money that the shareholders have. That's what it. Okay. Moving on, we have fixed assets turnover ratio. This is a pretty simple one. It shows what is your asset utilization. Yeah, simple. Net sales divided by your average fixed assets. Whenever we say average value, it's opening balance plus closing balance divided by 2. As simple as that. Yeah. So if you divide your net sales by average fixed assets, it gives you how much conversion of, how many times you were able to roll that sales into that fixed assets value. Yeah. So if you have a higher ratio, meaning that you have a higher number, multiplier, yeah, it means that you are using your fixed assets more effectively, yeah, meaning that you are using your asset utilization is very high. Whereas, and also whenever sometimes the investors are investing heavily on fixed assets, they will always closely monitor this ratio to see that if this asset addition has rewarded it with additional sales. So this asset turnover ratio has to improve over time whenever there is a significant investment that was made on fixed assets. Yeah. Now, there is no exact number. Yeah. So it's always better to compare it with the historicals, more importantly with the historicals and also with the PS. Now, when your manufacturing has been outsourced, then this is not a good indicator for the company. And not a good indicator as in you cannot consider this as a indicator for measuring the strength. Yeah, because your manufacturing has been outsourced. Shall I move on to the next one?
Yes, yes.
Yeah. So the next one is a bit
Are we not
tricky.
recording it? Are we not recording?
I don't know. Anirudh, are you recording it?
Please record now. I've come to the hospital.
He told he's recording.
Yeah.
Okay. Yeah, you're audible. Yeah.
Yes, sir. You are.
Yeah, got it. Thank you.
Okay. This is the next one is a very important one and a bit difficult to comprehend for anybody with a non-finance background. But it's if you think it in business terms, the cash conversion cycle. I mean, ratio number 9. Yeah, or sometimes we call it as working capital cycle. Basically, what it means that how much it's measured in days. Okay, and it actually measures what is the number of days that I need to convert my investments in inventory and other resources into realization of my money from sales. So today I have invested my money into inventory. I will be assume that I assume that I purchased inventory for 50 today, which is 9th of October for $50. I'm able to sell it and realize my money by 15th of November. So you tell me, what is my cash conversion cycle? Just imagine, I mean, don't look into any formulas or anything. But tell me, today I purchased some goods. Assume that I purchased today on cash. Yeah, I paid cash. Like for example, I purchased goods worth 50 from Anirudh. Okay, Vilas purchased goods worth 50 from Anirudh today on, and I am selling it to Abhijit on 31st of October, and Abhijit gives me my money back on 10th of November, say for example, simplicity sake.
No, I
What
think
is
it
the
is the
time
time
that
taken.
ah
I think it is the time taken from the day of purchase of inventory to the sales
yes,
of the final goods.
yeah, slightly I would amend it. Time taken from your date of purchase, assuming that it's on cash, yeah, until you realize the money from the sale. You
Absolutely.
might have,
From cash to
I
cash.
told it, I sold it to Abhijit on 31st of October, but Abhijit paid me only on 10th of November. So sales doesn't matter. When did I get my money back? I got my money back
Oh, okay,
exactly
okay,
after a
sorry.
month.
Yeah, yeah.
Yeah,
It's only cash transaction.
exactly, exactly. Now I will slightly, you know, amend the situation. Okay. Now you imagine that on 9th of October, I purchased $50 worth of goods from Anirudh. Yeah. And Anirudh agreed that I need to pay him after 10 days.
At a certain interest.
Sorry?
At a certain interest.
Huh?
With certain interest attached to it.
Uh, Assume that for the purpose of this example, assume that there is no interest. Okay. So,
Oh, okay. So then my cash cycle will be starting from the day of payment to borrow.
exactly. And you would have collected the money from Abhijit on 10th of November. So your cash conversion cycle reduced to 20 days, right? You're efficient, right? So this is the concept of cash conversion cycle. Yeah. So basically, that's why it says, what is the time taken to convert the investments in inventory and other resources into cash flow from sales? So this is mainly applicable where you have heavy inventory in industries. Yeah. So how do you calculate this? It's a combination of your inventory days plus your receivable days minus your payable days. That is, when you say inventory days, number of days of inventory outstanding plus number of days sales outstanding minus days purchase outstanding. So if you look at the same example, yeah, if you look at the same example, how much was my inventory holding period? Today I purchased on 9th of October, I purchased $50 worth from Anirudh. I sold it to Abhijit on 30th of October or 31st of October. So my inventory holding period was 20 days, right? Sorry guys, there's something. Hello?
Yeah, I can hear you. Yeah.
Yeah, can
Yeah.
hear you.
So basically, when I'm saying I purchased goods from Anirudh today, and I was able to sell those goods to Abhijit on 31st of October, meaning that my inventory days was 20, right? Correct? Hello?
Yeah, correct. Yeah, that's right.
Yeah. And my sales was outstanding because I sold this to Abhijit on 31st of October and Abhijit paid me money only on 10th of November. So my day sales outstanding was 10 days, 30 days. So if I consider everything as, purchase goods on cash, if I purchase goods worth 50 from Anirudh on cash, my conversion cycle would have been 30 days. But Anirudh has given me 10 days of credit period, right? So I would deduct this. So whatever is remaining is 20 days. Right? Cash conversion cycle. So the important thing to notice here is that, this needs to be constant over multiple periods, or it has to show a declining trend. Yeah. And the lower the cycle, the lower the number of days for it to churn your investments into sales and to further cash, it's better for the company. Yeah. One catch is some businesses like online retailers, as Professor was explaining in the class, would have negative cash conversion cycle. Yeah. So it's a formula is inventory days plus receivable days minus payable days. Now the catch is, how do you find out the inventory days? How many days of inventory you had in, what is your average inventory days? For one transaction, it's easy to estimate, but for n number of transactions, you need a formula to estimate. So that is why inventory days, you can easily get it by applying this formula, which is the average inventory is your opening plus closing inventory divided by 2, divided by what is your cost of goods sold that you find here. Yeah, cost of goods sold into 365 days if you are looking at it from a number of days point of view.
I think we calculated it in supply chain class.
Exactly. Yeah. I think inventory days, we worked it out in supply chain. Similarly, you have your receivable days and payable days. So same concept, average accounts receivable divided by what is your revenue per day. Payable days with your average accounts payable by COGS per day. Yeah. So just remember this formula and then you remember this concept. Then it will be easy for you to understand the concept of cash conversion cycle. This is very important. Yeah. Next one is free cash flow to sales. See, this one can I skip for now because I am also not sure about this. I don't know if anyone can explain this to me. That would be good. But I didn't get this ratio info. Yeah. Pawan, do you know what is this ratio of free cash flow?
No, I don't.
Huh?
No, I don't.
Okay, so we can cover this later. I need to do some further research on this because I couldn't visualize this kind of a scenario. So probably that's why. I will get back to you guys with this. Yeah. Then
Any
another
idea
important
what did it tell? What kind of questions will come?
kind of questions.
So
See,
what I'm
we'll have to remember the
expecting,
formula.
see, I think it'll be simple. I think what he'll do is he'll give you the current assets, current liabilities, and ask you to either calculate it or he'll give a ratio and he'll ask you to interpret it. For example, he might say that the current asset, the current liability is 1.5. What do you think about this? Is what I'm guessing. So it'll be a multiple choice question. I'll give you options that this means the company is slightly performing bad. The company can do better. I think those sort of things only I'm expecting.
I'll
That's the
retain the shares for the long term,
yeah,
or I'll
that's
sell
the
the
maximum he
shares.
can ask. So I don't think he'll do complicated by doing this free cash flow and all. So for and I think the question paper is not set by Rajat Bose. It's set by Rajvanshi sir, I think. So the people
Oh,
who taught
can't,
us,
can't
I think,
credit.
except the risk guy and that valuation guy, except the risk, I think they are not setting the paper. So that's the thing.
One second, guys. Yeah, I think as Pavan was mentioning, I think it would be either based on a ready-made application of a formula, or he might give us this is the situation, or maybe one question he might ask us to work out, like we saw in other papers. Next question will be follow on that if this is the case, how do you interpret it?
I agree with you.
Huh?
I just a second. I agree with you
Hmm.
because the way he has taught in the class, he has hardly introduced the ratios and then given uh, a part of the financial statements of multiple companies.
Yeah, so most likely it might be interpretation, Pavan. I think if he has
Mm.
gone covered more practical scenarios and how to interpret these numbers, this is how you see here. So maybe interpretation might outweigh the actual
Yeah.
calculations, but you
So I
never
think
know.
it's going to be very simple only. I don't think he's going to complicate it by giving us all these FCFs, or at the most he'll stick to two profitability ratios and few operating ratios, which are like earnings per share and current asset by current liabilities and fixed asset turnover, those sort of things. The
Yeah.
other thing I'm explaining is he might ask the order, the order which you showed, starting from sales minus cost of goods sold. So he might ask you to rearrange and say what comes first, what comes next. So those sort of things, the format of the P&L. So I'm guessing that might be an option. He might give like what minus what gives you PBT, something like that. So it'll be a
Uh,
simple uh, jigsaw puzzle sort of question.
yeah, I think if it's something to relate to formula, it will be very straightforward. If it has got something to do with, we can expect more tough questions when it comes to interpretation.
Okay.
Anyway, let's proceed. Next few ones are very easy. Operating profit margin. Operating profit, we talked about it, right? Earnings before interest and tax, which is your profit from your core operations. Again, here, better margin is always, higher margins are always better. And then you have net profit margin, yeah. And this is one of the most important ones. How much is your net profit ratio? Yeah, how much of each dollar of revenue that you're collecting, out of which how much gets translated into your shareholders' profit, which is available for distribution as dividend or as retained earnings. So this is I think very important. Yeah, profit after tax, net profit after tax divided by net sales. So this ratio is very important. Yeah. Then return on capital employed. I think this we discussed before. I was telling you like anything to do with capital employed, you should always interpret it along with return on capital employed. So it says what is your, what is your company profitability compared to your capital that you have invested or capital that you have employed. So earnings before interest and taxation divided by your, what is the capital employed, that will give you this ratio. Yeah. Again, it's a percentage. So how much of this, you know, for $1 of rupee that you're, or dollar of capital that you're investing, how much is your return percentage? Yeah. I still don't understand the difference between return on investment and return on capital employed, but for the time being, I will stick on to return on capital employed. Yeah. Then return on invested capital is something similar. Yeah. Uh, I think it's slightly. I mean, it was a bit complicated. You know, net operating profit
I
after
think it's a
tax.
matter of retained earnings being considered or not, right? I think it's a matter of retained earnings being considered or not. Also,
Operating profit after tax. Yeah, operating profit divided by invested capital. Yeah, so
Then just removing the tax element out of it, I think.
yeah, I think he's just considering the operating profit after tax.
Yeah,
We were looking at the net profit, but here,
yeah,
what is the actual return on invested capital is your net operating profit after tax.
yeah.
Yeah. Return on assets, again something similar to what we have seen before. Yeah, how much return that they're getting on their total assets. Again, net profit after tax divided by total assets. Yeah, and then higher ROA means higher asset utilization. But again, return on equity, same concept. What is your average shareholder equity? That is your denominator, and what is your net profit? Yeah, and then that will give you return on $1 of capital, $1 of equity that is being available to the shareholder. Now, the higher the return on equity, yeah, better, the better profitability is made. Yeah. But again, asset intensive industry, definitely the ROE would be lower, yeah, than a technology firm. Yeah. And this is not taught in class. I think I did some research and then found out that you know the benchmark is, if you look at the S&P 500, they consider the Q4 of 2022 13.29 as the minimum, as an acceptable return on equity rate. That is return on equity. Adjusted EPS is your earnings per share. So earnings per share and adjusted earnings per share, only one difference is there which you need to understand is your earnings per share is your net earning without including your extraordinary items or anything that one-off payments or one-off events that has happened in the year. Like for example, you sold a big chunk of your machinery this year for a profit or a loss. That doesn't happen every year, right? It happens once in a blue moon, right? So this event we call it as an extraordinary item. So that you need to remove from your net profit. If you remove these kind of items from your net profit, what you get is your adjusted earnings. And if you divide it by the weighted average number of shares, you get the earnings per share. Always higher EPS is better, yeah, but always need to consider what is the total number of unit shares or number of units that are there in the share capital. Now that is why they always say that it should always be judged in comparing it with the PE ratio or the price earnings ratio, which actually compares what is the company's their price, yeah, which is the market valuation of the company per share to its earning, yeah, or how much of what is the earnings multiplier, yeah. If that multiplier is high, it means that market is actually giving a kind of high expectation that because I'm assuming a value, I'm giving a high market value means that even my earning will grow in the future, yeah. But if my P ratio is getting lower, it means that the market is reducing its expectation, right? And if a company has got zero profit, there is no question of P ratio. Yeah. Then price to book ratio is similar to P ratio, but only thing is that you have the market price per share divided by what is the book value per share. So book value, you remember, if we have contributed 100 rupees as share capital, that is the book value of the share as per company's. Whereas today the worth of my share was 500. So this ratio is 5 times, right? But then why is it written that there is
Vilas,
yeah?
Is there any of the presentations that the professor had shared? He gave the list of ratios to be covered.
No, actually, what I did was he was talking through these ratios through examples, right? From generated from that tool. So these were the ratios that were there actually.
In the PDFs that he has attached in the presentation.
Yeah, I will show you where I saw that. Yeah. Yeah, in the PPT. Yeah.
I think it is session 3.
Not this one. Maybe session 2.
No, session 2 is okay. This is just the introduction. It doesn't have a ratio. This one doesn't have the ratio.
3. Okay, probably session 3.
If you see 3,
Yeah, session 3. You remember? Yeah, this
This
one.
is the
Yeah.
KPI. So are you collecting it from here?
Yeah, exactly. Exactly. That's why
Okay. Okay.
you'll find quick ratio, current ratio, interest coverage ratio, fixed assets turnover, cash conversion cycle, debt equity ratio, free cash flow, operating profit margin. Yeah, I based it on this one only. Yeah.
Okay. Okay.
Only thing is,
Thank you,
I'm
sir.
not sure about these ratios. I'm also not fully confident. The valuation related ones. I'm struggling here on ratio number 19. Yeah. Enterprise multiple also I'm struggling. This dividend yield also I'm struggling. I mean, I still need to do some research to
Sir.
understand what
Okay.
exactly it means to communicate it to you, because otherwise I'll be just reading out from this itself. Yeah.
Done.
Give me some time. So 3-4 ratios I need to come back to you, which I can cover it again on Wednesday when we connect on valuations. But other than
Sure.
that, go through this. I think this sheet was shared before. If you have any questions
No, no,
on
I know
either,
the book he has referred to.
yeah, yeah.
There is a financial ratios book.
Oh, okay, okay.
Unfortunately, I have the hard copy, but I don't have the soft copy to be shared.
No worries, no worries. And then if you guys have any questions on any ratios, just come back to me.
Sure.
Yep, sure.
So
Thank you
most
so
likely,
much.
no worries. Most likely is we can connect again on Wednesday on valuations, and we can cover whatever is the remaining ratios which I couldn't explain today. I will try to do some further research on that and come back. And if you guys have any questions in the meanwhile, feel free to shoot or we can discuss it on Wednesday. See, Wednesday we'll try to wind up because we all need to study also, right? I
Yeah.
also need, okay, I need to study the remaining areas because this ratio analysis is only one, like 20% only, right? There are other areas like valuations, like risk management. I also need to study. So let's try risk management. Again, I'm not the guy to help you guys with that. I will share my notes, but I think something, even if I tried teaching you, even I'm not fully confident. So we, uh, no worries. Yeah. Yeah, yeah. So let's try to connect on Thursday then, because Friday would be very difficult because my weekend for Saturday is anyway gone. So I will be out on out on Friday. Okay.
The risk management. Yeah, yeah, sure.